Hello, everybody, and welcome to Masters of Real Estate. Today, I have my syndication attorney on the line, Kyle Swafford, that has been working with us for a while now and helping us with all of our legal docs when we do syndications. And today, we are going to talk about some very key things that you need to know when you are investing and raising capital, how to stay out of the hairs and the sights of the SEC, how to do your legal docs correctly, how to structure your deals correctly, and all different types of tidbits and great information to be able to propel you forward on your capital raise journey and being able to raise money correctly for your deals. So thanks so much, Kyle. I really appreciate you being here today and sharing your knowledge with the world on, the syndication space, which a lot of people have issues with and don't understand the right rules and regulations and how to do this correctly, right? How to make sure that they are on the right track, being able to make money and raise capital and for their own deals and be in compliant with the SEC and some of the rules and regulations that go along with that. So could you give us a little bit of background on your experience and, your background and how you became an attorney as well, and then what led you to the syndication space and, some of the different activities you do now, man?
Absolutely. And thank you so much for having me, Matt. I really appreciate it. I'm happy to be here. As far as my journey to being a lawyer, because I can touch on the commercial real estate and SEC parts after that. People think I'm joking when I say this, and it's probably just because I'm dry. But ever since I saw the movie Liar, Liar, when I was like 7, I wanted to be an attorney. I just thought Jim Carrey was so funny. He was wearing a suit, the courtroom presence. Like, I swear I'm dead serious. And ever since I was like a little kid, just probably past a toddler, I just knew that I wanted to be an attorney. So as far as I was concerned, elementary school was just to get me to junior high, which was just to get me to high school, which was just to get me to the 4-year degree and ultimately law school. Like, every educational milestone was just in furtherance of getting to law school. So I just always knew I wanted to do it. Probably in college, I could probably solidify the law school path, because when you're at a house party, it's like, what are your beer pong rules? You know what I mean? So I was always rules based, I guess. And then in terms of how I kind of ended up in this space, a lot of my focus in law school was business related. I have an accounting degree as well. So after law school, I got into tax law. I got a tax law degree. I worked at Deloitte for a year, probably worked for 3 to 4 years litigating against the IRS, representing taxpayers, various situations, right?
You're my new favorite person now.
Oh, yeah, right. Yeah. Did that for 3 to 4 years. And, a lot of people think it's bad people not paying their taxes. Sometimes it's a single mother with 3 kids playing with her withholdings because she's got to buy food, right? It's not always just like these millionaires that owe this money kind of thing. So I think that gets a bit of a bad rap.
We
But
deal with the
anyhow,
California Franchise Tax Board quite a bit, and it's definitely their fault for sure.
yeah, right. Kind of doing the IRS route for a bit. I wanted to see if there was something else out there that was just compliance litigation. And I saw a firm that was hiring for commercial real estate and securities. And ironically, property law was one of my worst subjects in law school. I just was like, water rights? I live in the South. Why do I have to deal with water rights? Why am I even learning this, And then you realize commercial real estate is really not about any of that. It's mostly contracts driven, and that was something I was really good at. So the fear that I had in initially accepting the job was, oh, I'm not good at property. The moment I shifted it to, no, I am good at contracts though, and it's probably a lot of contracts, and then I just kind of fell right into it, both with the SEC compliance and the commercial real estate part of it. So after I was at that firm for about a year and a half, I started my own in January 2023, and we've been growing since and meeting good people like yourself. So it's been an incredible journey that I'm blessed to be a part of.
That's awesome, man. And, it's interesting when people talk about the syndication space and raising capital via syndications or funds, I use those terms as meaning the same thing. What they don't realize is you have to almost become an attorney, or at least understand the provisions that are in your documents so that you can explain them to investors. And I think that's what makes a good attorney as well, is having someone that teaches you what these provisions mean and helps you to be able to dial in exactly what your goals are with regard to these docs. And there's a lot of things that go into the docs. And I tell investors all the time, they need to be reading the docs in depth, right? And you as an operator need to be understanding these docs to answer every question possible. So your attorney becomes a 10 times more valuable team member because you need them to teach you to be able to answer the questions over here for your investors, right? Once you get this process down, it's not as hard as it seems, but there's crazy intricacies with each type of asset class that you're working in.
That's right.
And different provisions that certain operators want and certain operators don't. I mean, I've seen some crazy things in these docs, like you can't get rid of the operator no matter what, even if there's fraud involved, right? And stuff like that you're just like blow your mind type of stuff. And you see that there's a balance between protecting the syndicator and the operator, right, as well as protecting the investors involved and making sure these docs are not one-sided and they're actually fair, but also protecting the operator, which is usually the goal here in these docs and the reason why you have these. Can you talk a little bit about the importance of the docs and some of the main things you see in some of the provisions of these docs? I know this is gory details and put you to sleep type stuff,
Sure.
Sometimes, but, having an overview of this is really, really important. I'm just curious as to what are some of the actual main, concerns you're looking at when you first start a set of docs for somebody, say in the debt space or the multifamily space or something like that when they're, creating these docs.
Yeah, that's great. So I think regardless of what the purpose of the raising capital for, you're definitely going to have the three same documents. You're going to have a private placement memorandum, what I will refer to as a PPM. You'll have an operating agreement, which I may call an OA, but I'll try to say operating agreement. And then you'll have a subscription agreement. Now, those all contain different functions. So the subscription agreement is saying, I agree to be a subscriber to the company. I'm going to give this much money, receive this many shares. And we're not talking about the PPM or the OA for a second. We're just talking about the subscription agreement. We're saying this is the type of person I am. I've read all of the documents. I'm accredited, or I'm sophisticated if I'm not accredited and it's a 506B deal. And we can touch on that later if you want. But basically, the subscription agreement is saying, I know the type of investor that you're looking for. I'm indicating that I am that type of investor because I've read the documents, I'm knowledgeable, I've had the chance to review them with my financial advisor, or I've waived that in the event that I didn't. And now I'm telling you, I'm either accredited or I'm non-accredited. And if I'm accredited, here's why. Maybe it's I have $1 million net worth, excluding my personal residence. Maybe I have $200,000 the last 2 years and have the reasonable assumption I'm about to do it again, or 300 if married. So you kind of check why you're accredited. So the subscription is more aligned with what the SEC is looking for in terms of kind of how we know people are accredited or not. The operating agreement doesn't really reference the SEC at all, or any of the SEC rules, because now we want to know, how are we going to govern ourselves as members of this same company, right? In a syndication, there's going to be an area about voting. And when you're a passive investor, you have virtually very little voting rights. And you want it that way, right? If you're passive, you're insulated from risk because you're not the one making the operational decisions. If you started chiming in, no, I think we should do this, or no, I think we should do that, and that or this is the thing that leads to some sort of liability, well, now you're kind of opening yourself up as kind of voicing your concerns and wanting to be kind of in that space. So sometimes not only do the sponsors need to protect themselves, they also need to protect the investors from themselves, because no, I understand that you're writing a large check, and I think that's great, but wealth is about not losing money. It's not about making money, right? And then one of the last things is the PPM. That is kind of what I call an overview disclosure document that has a little bit of operating principles, how the company is going to be run, and then it has a little bit of
plan type of situation.
Yeah, that's right. That's right. Like if I think you could go to any PPM, whether it's for a debt fund, a multifamily, self-storage, you're probably going to have an overview about the company, about the manager, about cash flow splits, and then the risks inherent in whatever it is. Risks associated with senior debt, risks associated with junior debt, risks associated with construction, development, delays, etc. So they're all going to kind of have that same general outline, and it's really about making sure that you've disclosed everything.
I think that's really key. With the PPM, the private placement memorandum, you're talking about, the business plan, what you're going to do, what the returns are. If there's a preferred return involved, meaning investors get paid first before the operator gets paid, and then there's usually a split afterwards. There's asset management fee disclosures. There's, upfront due diligence cost disclosures. And there's a massive level of risk disclosures of every possible risk you can think of that you would put that could go with that particular type of project out there. And that is really, in my eyes, to protect the investor or protect the operator, which the sponsor, operator, they're the same people, right? They're the ones raising the money and doing all the work of the deal. That's the general partner of the deal versus the limited partners over here that should be more passive. And it's a very good point you brought up about, the limited partners and wanting to be passive so they don't open themselves up to liability. But also from an operator's perspective, you don't want all these limited partners involved in the day-to-day operations. They're relying on you as the general partner, the operator, the sponsor to come in and do all the work and be able to qualify for the financing and go out and do the operations and the asset management and do the value add project. And all the workload goes on the GP's shoulders, while the LP investors, the limited partners, are usually passive, just investing in shares of the LLC to get, cash flow out of it, hopefully, or a return on their investment, out of it at some point in the future, right? And so,
That's right.
and then, when you talked about the accredited investor aspect of this, it's very important to understand there are 506B deals, and we'll talk about some of the exemptions in a second, that you can have non-accredited investors invest, or you have 506C deals and other types of exemption deals where you can basically go through and have accredited investors only invest in those types of deals. And there's different structures for different exemptions. I'm going to have you talk about some of those exemptions in just a second. But really the idea here is an accredited investor typically, historically, has been someone that has $1 million in net worth, excluding their primary residence, or makes $200,000 a year individually or $300,000 a year married. And if you hit those thresholds, then you're considered an accredited investor. Now, there's some new rules out, right, that are showing that basically SEC came out with guidance basically saying that if you invest over $200,000 individually or $1 million as a company, then you can be considered an accredited investor, and the sponsor can take that as a indication that they are accredited then in that case as part of their due diligence to make sure they're accredited. Is there anything else I'm missing on that piece with regard to that accredited investor part?
Not really. The new rule that you referenced is you had it right. It's also $1 million or more if it's an entity. So sometimes people might pull their money together and do $1 million that way. That can also be a reasonable verification step as well. So I'm just going to add to that. But you're right. Now, the SEC did not say if you contribute $200,000 or more, you're accredited. The SEC said if someone has the capability of doing that, then it's reasonable to infer that they're accredited unless you know that they are not. And,
Gotcha.
that it just becomes on you to be honest about it. But
documenting that they have the power to go through and invest a couple $100,000 in your deal, even whether they do or not, is sufficient to be able to actually do your homework as an operator to verify accredited investor status, which is what usually they have to go through and get an accredited investor letter from an outside CPA or party that actually goes and looks at all their financials to make sure, are they worth over this? Have they made this money for the last 2 years? To verify those things. And this is a big step for a lot of investors where they don't have to jump through that crazy hoop that usually costs $100 or $60 or so to get accredited, in that way, which is a huge benefit, I think, for a lot of investors not having to jump through that hoop, because it really is a barrier to entry if someone has to go put together their personal financial statements and show someone I'm worth this much. I'd say 90% plus of the people that I know, even doctors and, attorneys and even CPAs, don't have that document put together. And so you're talking about a couple of hours of a task to put all this together, to provide it to somebody else to get a letter. And now you don't have to jump through that hoop as long as you can verify some of these other, pieces, right? The $200,000 capability or $1 million capability, right?
That's right.
And can you talk a little bit about some of these exemptions, right? So normally my understanding, and correct me if I'm wrong, is that if you're investing in shares of an LLC, then that's investing in securities, right? So you, as an operator, if you're selling shares of your LLC, you are selling securities unless you fall under an exemption. Does that all sound right so far?
Somewhat.
Okay.
So
I'd love for you to explain,
the
please.
no, yeah. The distinction as to whether something is a security or not depends on the role of the purchaser, which is
Okay.
passive or not, right? Like
Gotcha.
people create joint ventures all the time. Three brothers get together to purchase, a real estate property in their hometown, right? I mean, that's common. You may have even seen some of those house flipping TV shows on HGTV where there was a backer and there was a couple, and after a while they split the profits. That's not really a security. But the way that I kind of discuss a security is, and I'll say the definition first and then I'll say it again with examples. So a securities would be a group of people receiving a financial benefit based off the work of someone else. So to kind of say that again with, tags here, a security would be a group of people, passive investors, receiving a financial benefit, preferred return, cash flow splits, profit splits, etc., based off the work of someone else, i.e. the sponsor and GP team. So when that is present, that's when we have a security. So now we have to ask ourselves, okay, we're selling securities. What are we going to do? Well, you either have to register it with the SEC, which is basically like an initial purchase option, an IPO. You have to find an exemption or not disclose it to the SEC at all, which would be illegal, right? So what everybody does is they find the exemption. And the most prevalent types are 506B as in boy and 506C as in cat, right? 506B and 506C.
Okay, gotcha. And so even this is, I think, a misconception from a lot of people is that, hey, if you go do a joint venture with somebody and you have a couple of people involved, and they're not doing any work and you're doing all the work as the joint venture operator, that maybe you're fixing and flipping a house and you have a couple of people that want to joint venture with you and put money in and they're not doing any work, then that could be considered a security, whether you have an entity for it or not, that they're investing in. They don't have to be investing in actual shares of an LLC. They could invest into the joint venture where they're expecting this gain and they're not doing any work. Is that correct?
That could be the case. It depends on if they're guaranteeing the debt or not. But
Okay.
painting with the broad brush here, yeah, that's right. I mean, the SEC, and a lot of people will even come to me and say, I've only got 4 investors, or I'm only raising $500,000. I'd like for this to just be my public service announcement here. The SEC does not have a bright line rule as to how much money you're raising or how many investors you have to determine whether it's a security or not. Right.
Gotcha.
Like the SEC doesn't care if it's 5 or 55. The SEC doesn't care if it's 500,000 or 500 million, right? Like if you have passive investors from whom you have taken their capital and are supposed to work for it to generate a return to them, that's a security. And that's where a lot of the people can say, well, they kind of look at it as a cost perspective. Like, well, a joint venture, maybe I can get that document off of LegalZoom, but if I syndicate it, and I have to go to an attorney and all that, then, I'm dipping into my returns. I actually think that's the negligent way to think about it, because a lot of people get scared of the SEC, and rightfully so. I'm not saying that they shouldn't care about the SEC.
Right.
What I'm saying is there are other people here, like plaintiffs' attorneys. Like if you are taking money from other investors and the SEC finds out about it, aside from an audit, it's probably because an investor blew the whistle. Right. And if you are in violation of SEC rules before you even get going, it's going to be real uncomfortable question from a plaintiff's attorney in a deposition when he says, so you were the operations leader. You were the person that was in charge of all this. How you lost everybody's money. You weren't even following federal law. How can we assume that you knew what you were doing and following state law? And that's going to be a really tough question to answer. Right.
That makes a lot of sense. And so really it comes down to protecting yourself from the get-go, because if something goes wrong on that deal, which they go wrong, often. We flipped 1,000 houses. I swear I know 1,000 ways to lose money on a house now, and you learn lessons the hard way. You never know when a deal is going to go wrong. And so when a deal does go wrong, That's when, if they go call the SEC and there's an issue, or they didn't file the documents correctly or do the right exemption, then you're basically screwed at that point, because now you didn't follow the law, and now you can be held personally liable for this because you didn't follow the law here. They can get you on that. And any plaintiff attorney, any SEC attorney is going to know this right off the bat when someone comes and talks with them about this type of issue, right?
That's right. And that's the thing, the SEC exists to protect investors. That doesn't mean that the SEC exists to completely and 100% indemnify investors, right? People lose money investing all the time. Look at 2006, 2007, right? Like the SEC is going to go, did he disclose or did they disclose the risks? Did they file the right paperwork? If they did, there's really nothing we can do. Investor, we're sorry that the economy just took a turn. But if you don't follow the SEC's rules and regulations and you don't file the necessary paperwork, you could have, and this will happen. People will not be aware of SEC rules their first deal or two, maybe make a mistake in on their fifth deal. And the SEC just kind of looks at everything as a whole. I mean, it's like the IRS. If they're auditing you for 1 year, they're going to look at other years, right? So the SEC is the same way. If I'm auditing deal 4, I might as well look at deals 2 and 3. And if they start seeing a pattern of, violations, they may say, look, money was lost. That's not necessarily the issue here, but you were breaking these rules and regulations, and now we're going to require you to pay penalties and owe your investors, an X percentage of their money back. And then then you're probably looking at bankruptcy at that point. So there are real problems by not following these rules for sure.
If there's someone in that situation now that has these types of issues that have done it wrong, right, where they didn't syndicate correctly, or maybe they're doing a joint venture and had no idea that they had to go do these filings, right? What would they do after the fact to then be able to correct the issue, to be able to solve that problem afterwards? Is there something they can do afterwards, or like redo the disclosures and refile now afterwards or something? Because, in the beginning, you would go to all these real estate clubs, you learn, how to do these deals, and nobody talks about joint ventures being securities, right? Or, utilizing investor capital that is, to be able to go do your fix and flip, and that being a potential security. That's not something that's necessarily taught all the time. And so what do people do if they screwed up in the first place? Say the deal didn't go bad, it's still going good, but they're in the middle of a deal and they make a mistake. What is there something that they can do to correct or fix the issue?
Yeah, so I'm almost scared to say this, but I'll do it. Fun fact, a PPM is not required in any syndication of any kind. Okay. It's not a requirement. It is highly, highly, highly advised by the SEC, but it is not a requirement. The reason it's so highly advised is because this is where we're defining accredited investors, non-accredited investors. This is where we're disclosing risk, right? So if you didn't have a PPM, and you probably should have, that's more about your protecting yourself, and you kind of failed to do that. What your question, Matt, is about, what about the people that want to be compliant with the SEC? What should they do? Well, they should look and see, what type of investors did I have? Did I advertise or not? Probably didn't. If you did make the mistake, it's probably not known. But I would just file the Form D, which is a federal filing document that you need for any syndication. I would file it, even if it's late. It's better to file it late. And if they ask why, just say, I didn't realize I was selling a security. Now I know, and this will never happen again. That's forgivable. What's not forgivable is having a repeat pattern of constantly offending the rules and regulations and then never doing anything about it. It's kind of like your taxes, maybe, right? Like if you amend them to fix something, that's going to be seen a lot better than, well, let's just see how it looks on the audit, and then they find it, penalize you, interest on top of it, right? It's a bit of the same concept.
Asking for forgiveness up front shows an intent to correct any issues that came up, which people make mistakes. It's understandable as long as they correct the issues, right? So, one other thing that I think is important to bring up is, you talked about the passive nature of these people. If you have a joint venture where you only got 2 partners involved, for example, there may be a way to structure it, and you have to have substance and form where they are actually doing work involved, even if they're investing. They're not just putting capital in. They actually have to perform active duties in order for them to be not passive investors, but more active investors. Now, that leads them to potential liability and things like that on the deal, of course, and they should be covered for that. But my understanding is as long as they're actually doing work, you could say that they're doing all the work, but if they're not actually doing it, then it's substance over form, and the SEC is going to see right through that potentially, right? So does that solve some of the problems on the smaller basis, other than liability for the LP?
It can, because I mean, if you're doing a smaller deal, let's say like the example where, 3 people get together to flip a house or something like that, right? If you're splitting that a third, any lender is going to require them to be a guarantor on the loan because they own 20% or more of the asset. So purely by being at risk on the loan, they're having a managerial impact on the company. Also, too, attending regular meetings, voting, being present in the deal. Any deal, whether there's a manager or managing member, doesn't really matter. Somebody's running the day-to-day. You don't need 5 people to run the day-to-day. It's these material matters that come up that we need to start having people actively involved. And if people get outvoted, they get outvoted. But if they're just constantly turning in a proxy, then they were never there. And this isn't to say sometimes people get sick, sometimes things come up in life, but if you're just in and out, never there, you're starting to look passive, and that's when you have these considerations.
Makes a lot of sense. And so, we talk about a little bit about the differences between 506B exemptions. So a 506B and a 506C is just an exemption from securities laws, right? So you're still selling securities, but you have an exemption that you are basically a part of, where you are filing with SEC and asking for this exemption, right? And I know, 506B deals, you're allowed to take non-accredited investors, up to 35 of them, to be able to invest with you. And then 506Cs, you're not allowed to go through and take non-accredited. It's accredited only, but you can potentially market it out there and get the word out for people you don't necessarily know. Can you talk a little bit about some of the differences there, including, some of the rules that a 506B has that a 506C doesn't have, and kind of the main differences, and also the risks? Because a lot of people say, hey, only do 506Cs because they're all accredited and high net worth investors, versus even dealing with people that are not accredited because of the potential liability differences and stuff like that. Can you kind of just briefly touch on some of that topic?
Yeah, so I don't really think that one is better than the other. I think they're opposite sides to the same coin, right? The pro for one is the con for the other. So in a 506B, the pro is that you can have accredited and non-accredited investors. This may be a doctor fresh out of residency making $500,000 a year, right? They're not accredited yet, but that's certainly somebody you want in your ecosystem, right? So you may do a 506B. The con there is that you're not allowed to generally solicit or advertise your offering at all. The flip side of that is in a 506C, it's accredited only, but you can advertise it, right? So you can already see in the first 2 points, the con for one's the pro for the other, right? And it just depends on your viewpoint. In a 506B deal, you're allowed to rely on the investor's designation status of their own accreditation, right? Whereas in a 506C, that has to be independently verified. Whether a CPA, lawyer, you can review their tax returns or W-2s, things like that, right? And then last, in a 506B deal, it's not last, but I'm coming back to it. You're prohibited from advertising your offering. And this gets lost a lot. The SEC does not prohibit people from advertising their company. They're prohibited from advertising a 506B deal. And, so many people, you should tell people, yes, my name is Kyle Swafford, and I'm the owner of Blue Delta Capital, and we invest in and develop commercial real estate. I should be able to tell people that, because otherwise no one is ever going to know that I exist, right? But if I said, my name is Kyle Swafford, I'm the owner of Blue Delta Capital, and we are currently under contract and inspecting Apple Creek Apartments in a prime location in Atlanta, Georgia. Well, I've gone a little bit further there. I didn't just tell you what I do. I'm now telling you what I'm currently doing. And if that syndication is a 506B, then you're violating SEC rules, because you are priming the market by advertising your company. But in reality, you're really kind of trying to advertise what you're doing and solicit offers.
That deal, right? And my
Yes. Yeah.
understanding is that you're supposed to have on a 506B a pre-existing relationship with that person and know that what their financial strength is and that they're sophisticated investors and have some background on who they are. Is that correct? And what are the typical rules there? Am I off on that, or is that accurate?
You're right. So in a way, so the substantive pre-existing relationship is a way that you refute the accusation from the SEC that you advertised. So I would say, no, I didn't have to advertise or generally solicit to this person because they are my brother-in-law. They're my best friend from college, whatever. It's not a requirement. If I had the time, I could pull up the code right now. Pre-existing and substantive is nowhere in the code. It's a test by which if I were the SEC official and say, Matt, how do you know John Smith? And you explain it, it's like, that's why I didn't have to advertise because I know that person. You could take a referral from someone you never knew that was not advertised or generally solicited. So like if you have an investor who was talking, at the country club to his buddies about your returns and is like, yeah, Kyle's got something right now. And, Jack Smith reached out to me, I don't even know Jack Smith. I didn't know John Smith had a brother. I didn't know that, right? I don't have to know someone's family tree to understand if they know commercial real estate investing. And if he told Jack to come my way and Jack emails me out of the blue, I, in theory, could take Jack's money without a pre-existing or substantive relationship because I didn't advertise or generally solicit. And I could document that because he reached out to me on the email and I don't have any emails to him, right? So 99% of the time, it's going to be based on whether you have a substantive pre-existing relationship, but there may be one investor every now and then, and you could take that capital because it was a referral.
Mm-hmm. Makes sense. And as long as it'd be probably smart practice then to document how you know each person involved. So if anything ever does happen, you have documentation, because something could go 5 years long on a deal or 7 years long on a deal, and then something goes wrong. And then going back to that later on and saying, how did I remember all these people? Let me make sure I'm backed up, is going to be a harder thing than doing it right away as people come to you and invest with you. So being able to document how you know these people that are investing in your 506B deal, I would think would be a smart practice to protect yourself if something ever does go wrong, which you don't 100%. Have control half the time. There could be a black swan event or, some liquidity issue in the market. We've seen, a lot of deals go bad in the multifamily space lately, and, people losing money and all that kind of stuff because the interest rate changed so drastically, so quickly. And a lot of people bought at the wrong time of the market as well. I know I took a couple of hits on some deals that I invested in passively because of the wrong timing on that and not realizing that interest rates are going to jump 2% immediately in a 6-month period of time, right? So I think that would be a smart practice. Do you see that happening often out there as well?
It does, and I think that it's pretty easy to do. I mean, so many times in life, the thing that you want is on the other side of just doing the thing that you're supposed to do, right? So if I were to give anybody advice, it would be the moment that you have that follow-up call with the investor, you should take your notes. Maybe you did it with Zoom and you have some sort of AI note taker, but you should just say, hey, John Smith, it was great meeting with you today or last night. It was great finding out that you and your spouse, how y'all met, your degrees. I understand that you're a doctor in this. Your wife is a pilot for 7 years, and your philosophy in commercial real estate is you want to be hands off and have mailbox money, so to speak. And what you've done is, in the event in the future things go sideways, you can say, okay, I don't necessarily remember everybody. Let me just pull up John Smith, and you're going to see in your sent email all the way down at the bottom where you emailed them the recap, where you spoke on June 10th, and then you had this conversation and you had a follow-up about your practices and your businesses, and it's pretty easy to do that. And then you can just save that email in your share drive of all of your investors, and you're pretty protected there, right? You've at least documented it. So right. Absolutely do that. It takes 5 minutes, and that 5 minutes could be the difference of something going sideways pretty fast.
Okay, that makes a lot of sense. And, going back to like the structure of these deals, what I see most of the time in some of the documentation of the deals and the structure of these is there's usually and sometimes this is not the case, but usually a preferred return involved where investors get paid first. And then there's some sort of waterfall afterwards where there's a split. It might be a 70-30 split or a 60-40 split or 80-20. And sometimes until they hit another hurdle, right? There might be an 8% preferred return, which means investors make 8% on their money first before the operator gets a dime. And then after that, it might be, a 60-40 split until investors hit a 10 or a 12% preferred return. And then a bigger waterfall for the general partner afterwards, where it might, revert to an 80-20 or revert in their favor or something along those lines, to be able to compensate and put the alignment of interests with the investors making a great return and the operators making a great return also, right? Have you seen any other types of structures out there where that was not the case, where you don't see preferred returns involved in these projects?
Yeah, a lot of times in development projects, or perhaps maybe a hotel conversion to multifamily context, what you
Okay.
might see a sponsor do is say, we're not going to take any fees, or maybe they take fees, but very minimal, but we're not taking any fees. We're not taking any income. Any profits that we get after debt service are going to you for you to get your money back, plus a 15, 17.5, 20% IRR. Then you're phased out. Basically, you're treating the investor capital as mezzanine debt, right? And you're saying you're second in position behind the lender. You're not secured, but contractually, we're not making a dime, and all money is going to you. And some investors want that because it's kind of like junior debt position, right? And they know, hey, 20% is better than any index fund that I'm in right now. I'll take that kind of mezz debt position, and whatever profits there are on the backside, I don't care because I've already made my money back plus 15%, right? So I think investors just need to be cognizant of, if I'm a passive investor, if I could say to every passive investor out there, the only question, if there's only a question to ask any sponsor, any operator, it's this. It's a two-parter. What would happen for me to lose all my money, and what are you doing to ensure that doesn't happen, right? And then if the operator has the answer for that and you feel confident in it, it's like, okay, I feel good then. Maybe it's we've taken a very conservative approach to our rent escalations. Maybe it's these are the numbers that I'm giving you, assuming that the development takes 3 years, but we actually think we'll be able to get it done in 2. So I'm showing you what your position looks like in 3 years. We think we're going to get it done in 2. So I'm being conservative here, or, we got a cap rate insurance policy. So if interest rates go up, we're covered, and whatever that case may be, there's always a reason where something could go wrong and you lose all your money. So what are you doing to protect that, right? So putting parachutes in planes, would be with something like that, right? So that's kind of what you want to ask the sponsor if you're a passive investor.
I think that's really important. And, we have a 200-point due diligence checklist that we go through when we're investing with different operators and doing background checks and criminal checks and looking at the deal, looking at the financial model, the market, the renovation, all different aspects of that particular deal. And as long as there's incentive for performance involved, and, the operator is not making a ton of money up front on the deal and then making very little on the back end as well. So there's incentive for performance where they make their money on the back end, after the investors get paid their funds, then there's alignment of incentives there, right? And that's the thing you want to look out for when you're investing with other people is that alignment correct? Are they making money along with me as long as I'm making my returns too? Or are they making all their money regardless if the deal performs or not? That's like the number one thing I'm looking at when I'm looking at these deals is that alignment of interest, right? Because everybody wants the deal to work and everything, but what's that alignment? And of course, do they have the experience to pull it off in the first place, to be able to do that, right? So, and if anybody wants that due diligence checklist, we have it on our website, MathewOwens.com with 1 T in Matthew, and you can download it for free on our site. We use this all the time for our own stuff, and people love our checklist because they use it now for their deals, right? And so it's really important. It's going to give you ideas of what to ask these operators, including about those risks you were just mentioning. If they can't name, the risks of the deals and how they've mitigated them, then you shouldn't be investing with that operator in the first place, because they don't see the whole picture, right? They're not seeing what's happening in macro and microeconomic environment in that particular market, or the risks of that deal on the renovation, and their construction teams and their property management teams that are in place, and who's their support system that goes around them in the first place. So it's in my opinion, one of the most important things to do is to do that homework and ask these questions up front and see how they answer. And if you don't get a good feeling about their answers, don't move forward. There's plenty of deals out there. Take your time, learn the right ways to invest, and you'll be in a much better space, because trust me, you don't want the deals to go bad. And a lot of times they can go bad, right? And so if you do all your homework, you're just mitigating the risk of that deal going bad as much as possible before you put your money in, right? So Kyle, this has been, a wealth of knowledge, man. I really appreciate you deep diving on some of these topics, because it's something that I think a lot of people don't understand if they're new to raising capital for their deals. And capital raising is the lifeblood of their deals to get this stuff done. So if anybody wants that due diligence checklist, again, you can go to MathewOwens.com with 1T and Mathew and download that for free. We also have other master classes on raising capital, finding deals, analyzing them, and quick analysis tools and things like that to analyze your deals in real time. So hope that helps. Thank you so much, Kyle. I appreciate it, and have a good rest of the day, everybody.
Do you want to learn how to create financial freedom in your life through real estate and take your investing business to the next level? If so, you can follow us in one of the following ways. First, you can take one of our free webinars on how to analyze property, how to raise capital for real estate, and how to market and find deals. 3 of the key pillars to becoming a successful real estate investor. Number 2, you can join us on our mailing list, where you'll get tips and tricks on real estate investing directly to your inbox. And number 3, you can take our 6-month real estate course that teaches you every aspect of real estate investing you can think of, and more importantly, create financial freedom in your life through real estate investing strategies that I teach. If you want a master's in real estate in 6 months, this course is for you. We're going to go over how to raise money, promissory notes, syndications, fixing and flipping, buy and hold investing, tax and legal structures, self-directed retirement accounts, financial education, how to run a business, how to market and find your deals, and most importantly, how to create that financial freedom in your life so that you can stop trading your time for money and create passive real estate cash flow that you can live off of. If you're interested, go ahead and click on one of the links below, and I look forward to seeing you guys on the other side.